Good afternoon, boys and girls. It's Wednesday, the 6th of April, 2022. Hope everybody's having a wonderful hump day out there. It is another beautiful day here in Colorado, clear skies, a lot of wind. If you remember, I talked yesterday that we were expecting a pretty big wind event here over this week. And while it's been pretty calm where we're at along I-25, car or semi trucks were flipping on their sides. It was a big mess. So, if you're trying to travel through Colorado this week, it's probably not the best to be driving. So, all right. Like I said, hope everybody's having a great day. If it's your first time watching, please click on the subscribe button and share with friends and family. I would greatly appreciate it. All right, let's go ahead and jump in to see how the markets did today. Dow Jones was down 0.42%, closing at 34,496. S&P 500 down 0.97, closing at 4481. NASDAQ was down 2.22%. Ugly day for techs. It was closed at 13,888.82. Small caps are also down 1 1/3. The VIX was up again today, another 5.09%, closing at 2210. All right, let's look at the other Americas. Canada was down 0.65, Brazil down 0.55, Mexico down 1/4%. Moving over into Western Europe, Germany down 1.89, UK down 0.34, France was down 2.21, the Euro stocks down 2.38, the Netherlands down 2.22. What is that? Spain down 1.64, Italy down 2.06. So yeah, across most of the European markets, it looks like they were down anywhere from 0.34 to a little over 2%. Moving to the Eastern Europe, again, more reds. The first green I see is the RTSI out of Russia was up 3%. The other Russian index was down 1.93, so kind of a mixed day there. Getting over into Asia, let's see, the only green I see is Saudi Arabia and the Shanghai out of China, which was up 0.02. So everything else, red, 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 all the way across the board. So for trading day, April 6th, not a great day in the market. So again, we are headed towards some turbulence, I guess would be the best way to put it. So do not be surprised by anything you see coming out of the markets right now. So, while we did have a lot of cash infused into the economy over the last 2 years, which really helped, raise all boats because it brought in a high tide. Well, the tide's getting ready to go out and we're going to see who's swimming naked. So it's going to be fun. All right, let's take a look and see at how today's market recap. Shrink that down. All right, S&P 500 slips as tech stumbles as Fed minutes hint at step up in tightening. All right. The S&P 500 slipped Wednesday as tech was pressured by rising treasury yields after the minutes from the Federal Reserve meeting were signaled that central bank members were in favor of stepping up the pace of monetary policy tightening next month. The Fed is, quote, well placed to begin the process of reducing the size of the balance sheet as early as the conclusion of its upcoming meeting in May, end quote. The Fed minutes showed on Wednesday. Under the plan, the Fed would allow about $60 billion in Treasury securities and about $35 billion in agency mortgage-backed securities to roll off its balance sheet, which currently stands at nearly $9 trillion. So let's do some quick math on that. So at $9 trillion balance sheet, millions, billions, 9 trillion divided by, what they say? 90. Yes, trillion by 95 billion. Take 94 months to let all that run off the Treasury balance sheet. So it'd take about almost 8 years. So I don't know if you're going to want to wait 8 years for inflation to go away, but anyways. All right, jumping back in, the 10-year yield topped 2.6% to surge to more than 3 years. Surge to more than 3 years, 3-year years as investors. God, this is terrible. Right to a 3-year high. As investors digested the prospect of Fed tightening monetary policy aggressively in upcoming meetings, growth sectors of the market like tech, which are less attractive in periods of rising rates and inflation, continue to creep lower, pressured by the broader market. Facebook led big tech lower, down more than 2%, while Apple, Alphabet, Amazon fell more than 1%. Chip stocks also struggled, pressured by a 6% slump in NVIDIA and weakness in Broadcom and Intel Corporation. Intel fell less than 1%, however, after the chipmaker said it would end or scale back operations in Russia following the latter's invasion of Ukraine. Tesla fell more than 3% as electric vehicle reportedly doesn't expect to resume production at its Shanghai factory until at least Friday following a COVID-led shutdown. On the deal-making front, JetBlue Airways fell more than 7% a day after the airlines tabled a $3.6 billion takeover bid for rival Spirit Airlines. In other news, Tilray bucked the broader trend lower, rising more than 6% after delivering an unexpected profit in the third quarter and announced its subsidiary, Manitoba Harvest, hemp powders would be available at more than 300 Whole Food Market locations across the U.S. All right. So again, things that we would expect to fall during, higher inflation, rising rates. So the tech sector is really taking a beating. Again, I don't think anyone out there is really shocked by this. So anyways. All right. Some news. U.S. Postal Service plans to raise prices of first-class mail. The United States Postal Service on Wednesday filed notice of a price change with the Postal Regulatory Commission that includes a 2-cent increase in the price of a first-class mail forever stamp from 58 cents to 60 cents. The proposed hike in prices comes ahead of President Joe Biden's announcement for about $50 billion financial relief over a decade to the USPS. Let me stop there. For those who are big government people who just love everything big government, whether or not it's NASA, the post office, whatever it might be, they'll always scream in my face and say the post office, they don't cost the American taxpayer anything. Well, that's a lie. They come up short every single year, and we also have to fund their pensions. So they're not exactly coming up or a self-contained unit within the U.S. government, which is profitable or at least breaks even, because they don't do either. So the proposal would raise prices of first-class mail and an affordable way to send envelopes in lightweight packages by about 6.5%. USPS said it. If the price hike goes through, the single-piece letter additional ounce price would increase to 24 cents. The metered mail 1 pound or 1 ounce price would increase to 57 cents, and the price of a postcard stamp would increase to 44 cents. A 1 ounce letter mailed to other countries would increase to $1.40. Forever stamps can be used to mail a 1 ounce letter regardless of when the stamps are purchased or used, and no matter how prices may change in the future. Struggling with diminishing mail volumes, despite having to deliver to a growing number of addresses, USPS has reported net losses of more than $90 billion since 2007. Remember when I said just a second ago that they don't make they don't make enough money to cover all their expenses? Right there, $90 billion. Who do you think makes that up? It's us, the taxpayer, idiots. Come on, sell it to FedEx or UPS. I mean, seriously. Yes, in the Constitution it says that the U.S. government can have a post office. It doesn't say that we have to. Struggling. Oh, we already covered all that. In February, it booked a quarterly net loss of $1.5 billion. The new prices, if favorably reviewed, will take effect on July 10th. So good news. Hey, more money to mail a stamp. So, all right. I'm also attaching here to the show notes the meeting minutes from the Federal Reserve from last month's meeting. I'm not going to read through all of this. It's quite long. Did highlight a couple sections here that I do want to breeze through. So in this first section, they're talking about, just what's going on in the financial markets and open market operations. And so let's go ahead and look at this. So moreover, futures prices implied that the federal funds rate limit would increase would increase around 170 basis points through year end. So that's what they're expecting, is that by the end of the year, we should be around, just under 2%, and about 70 basis points more that had been priced in at the time of the January meeting. So what they're saying here is that, at the January Fed meeting, they were expecting to go up to around 1%. Now they're expecting to go up to about 1.7%. Similarly, the median projection of the target rate for the federal funds in the open market desk's most recent survey of primary dealers and market participants showed an increase of 150 basis points this year. So again, those who are familiar with this business and how rates work, they're expecting somewhere between 150 to 170 basis points, across the board. Let's see here. This next section had to do with the balance sheet, which we just did talk about in that article I just referenced. So here's the final paragraph here regarding the balance sheet. No decision regarding the committee's plan to reduce the Federal Reserve's balance sheet was made at this meeting, but participants agreed they had made substantial progress on the plan, and the committee was well placed to begin the process of reducing the size of the balance sheet as early as the conclusion of its upcoming meeting in May. So they have a plan, supposedly, but they're really not going into a whole lot of details. So I find that quite funny. And then what was the next part? There was a couple other spots here. Participants' views on the current conditions and economic outlook. With regard to the economic outlook, participants noted that real GDP growth had slowed from its rapid pace in the fourth quarter of 2021, largely reflecting weaker inventory investment, but consumption and business investment continued to rise solidly. So, from that perspective, what they're seeing is that, while some aspects of the of production are slowing down, business investment, we're still, consuming the same amount of goods in the economy, even though things are slowing down. So, all right. And let's see here. All right. The committee policy action. All right. In their assessment of monetary policy stance necessary for achieving the committee's maximum employment and price stability goals, members agreed that with appropriate firming in the stance of monetary policy, they expected inflation to return to the committee's 2% objective and labor market to remain strong. So in their mind, everything, inflation is going to go back to 2% just by raising interest rates a little bit. So again, we'll see. In support of these goals, the committee has decided to raise the target range for the federal funds rate to 1/4 to 0.5%, and anticipate that ongoing increases in the target rate range would be appropriate. One member preferred to raise the target range of the federal funds rate by 0.5 percentage point to 0.5% to 0.75% at this meeting in light of elevated inflation pressures. With regard to reducing the size of the Federal Reserve balance sheet, all members agreed they had made substantial progress on arriving at a plan specifying the steps the committee would take. They expected that depending on economic and financial conditions, beginning the process of reducing the size of the balance sheet would be appropriate at a coming meeting, possibly as early as the committee's May meeting. So again, they've kind of decided on what they're going to do, but we'll wait till the next meeting. We don't want to get too far ahead of ourselves. All right. And then here's just the action points. Undertake open market operations as necessary to maintain the federal funds rate in a target range of 1/4 to 0.5%. And then the other one I found kind of interesting here is roll over at auction all principal payments from the Federal Reserve's holdings of the Treasury securities and reinvest all principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities in agency mortgage-backed securities. So if I'm reading this correctly, they're just going to, as these investments mature and you get your principal back, at least what I'm reading here is they're just going to reinvest it into more agency mortgage-backed securities. So aren't they just doing the same thing over again? So again, I'm going to want some clarification on this. So feel free to read through this. It's quite, it's a wall of text. And there's a lot of word salad in there. So again, government, they love to print words on paper. And so anyways. All right. Next article I got here. House panel passes 401k plan bill. Members of the House Education and Labor Committee voted Tuesday to approve a bill, H.R. 7310, that could affect married people who want to take cash out of their 401k account. So again, listen up for any married people who want to, get one over on your spouse. The bill could also create a federal consumer savings program that would be managed by the Department of the Treasury, and it calls for the Department of Labor to improve defined contribution retirement plan fee disclosure rules. All right, so let's get into the meat of this. One section of the McBath bill would set new notification rules when a married person tries to take large sums of cash out of a 401k account or other individual account governed by the Employment Retirement Income Security Act of 1974. We in this business call that ERISA. A married participant would have to get consent from their spouse before withdrawing large sums of cash. I don't know if I like that. A participant would not have to get spousal consent to begin taking distributions in the form of qualified joint or survivor annuity, or to roll account assets into another retirement savings arrangement that comes with similar spouse notification rules. So how do we feel about that? Do we want, it's your money, husband, wife, whoever you are, and depending upon how much, the other person's involved in the finances. Do you really want their permission to spend, the money you saved? What if, let's say someone's, a guy's 50 years old. He's worked his whole life. He's got, I don't know, $1 million saved in his retirement accounts. Then he marries, whoever, boy or girl, hey, it's a woke world. And, then now that person has a say in someone's retirement. I just don't like it. All right. Where's the next? McBath said at a hearing in March that she was introducing the bill because reports that some spouses try to hurt other spouses by emptying out their 401k plan accounts. Well, again, this is not a problem for the government. Another H.R. 7310 section would require the Secretary of Labor to review defined contribution retirement plan fee disclosure rules and, quote, explore how the content and design of the covered disclosures may be improved to enhance participants' understanding of fees and expenses, as well as the cumulative effect of fees and expenses on retirement savings over time, end quote. As part of such a review, the Secretary shall conduct outreach to stakeholders, including those representing plan sponsors and retirement plan participants, according to the bill text. A third section would let the IRS send 1/5 of a taxpayer's refund to a new rainy day savings program that would be administered by the Treasury Secretary. If a taxpayer opted into the program, Treasury would invest the cash in Treasury securities believed to be suitable for use in a rainy day fund. Yeah. Do you want these morons who have run up $30 trillion in debt above and beyond the $2 to $5 trillion that they've been spending every year, for the last 22 years? They're burning through money like it's, like drunken sailors. And again, I'm a former drunken sailor. This is really irritating to me. So yeah, we'll see if this goes anywhere. But I did want to make y'all aware of this because, I personally like to see the government, disappear. Let me say it like that. In case the FBI is watching, y'all can kiss my ass, but hope you have a negligent discharge into your face. All right. Last article. Deutsche Bank warns of a 20% bear market in 2023. Again, if you're not, perusing the financial pages, a couple times a week, everything right now is, there's an article from Janet Yellen saying, oh my God, the world's going to end. We're headed towards catastrophe. Everyone is, what's the word I'm looking for? Telegraphing, what's going to happen. So, all right, let's dive in. Deutsche Bank made waves on Tuesday when its economist became the first of the major Wall Street analysts to say the U.S. economy would soon go into recession. Quote, two shocks in recent months, the war in Ukraine and a buildup of momentum in elevated U.S. and European inflation have caused us to revise down our forecast for global growth significantly, end quote. Deutsche Bank economists led by David Folks Landau and Peter Hooper wrote in a 68-page note to clients, quote, we are projecting a recession in the U.S. and a growth recession in the Euro area within the next 2 years, end quote. but it does not reflect the mounting concern about the economy, especially as the Federal Reserve moves aggressively to cool business activity in its efforts to fight inflation. And last week's inversion of the 210s yield curve, a metric with a pretty good track record of predicting recessions, only embodied those expecting economic growth to turn negative. As TKers readers know, recessions are not great for stocks. The S&P 500 has on average fallen by around 20 to 30% during these periods. Deutsche Bank sees the stock market following the historical playbook from the bank's equity strategist Binky Chada. And here's his quote. We maintain our forecast for the S&P 500 and stock 600 for year-end 2022 with a typical recession correction of 20% in late 2023. Our projections for equity demand supply this year suggests equities would be well supported by strong inflows, a recovery in positioning to at least somewhat above neutral and buybacks, but this support should start to slow with growth in the second half of next year. We see some but limited impacts of European earnings from Russia-Ukraine war and multiples recovering into 2023. We expect equity markets to hold up well through the summer before the U.S. falls into recession, and for equities to correct by a typical 20% as it begins before bottoming halfway through and recovering prior levels. It may be easier for clients to swallow a 20% drop in stock prices when you call it a correction, but in case there's any confusion, a 20% decline is more popularly referred to as a bear market. I'm not going to tell you recession isn't likely in the same way I wouldn't tell you that a bear markets aren't likely. Recessions happen and big sell-offs and bear markets happen. This is what you sign up for when you invest in the stock market, but I'd caution against attempting to time the market. Most professionals haven't been able to do this successfully. Some of the biggest short-term gains in the market occur during periods of elevated volatility. So those who mistime the market will end up missing on important gains that can do irreparable damage to long-term returns. And history says there's only a very brief window between when stock prices peak and when recessions occur, which means the risk is high that you sell too early. In the past, the S&P 500 made its gains up until 6 months before the start of a recession. Andrew Garthwaite, head of global strategy for Credit Suisse, wrote in a note to clients on Tuesday. Unfortunately, there's information in Garthwaite's chart might be tradable only if you know exactly when the recession will start, and that's virtually impossible to do. By the way, if you decide to take a stab at timing the market and try to sell to avoid what may or may not be a sell-off tied to a recession, make sure you have a plan for buying back in. Remember, there's a chance stocks never fall below the price at which you have sold. So again, doesn't look real good right now. So let's look at the charts a little bit. So if we were to go back out and look at things over the last two major declines, back in 2008, we had a decline of about 52%. In what was that? In 2002, we dropped 25%. In 2001, we dropped 20%. So again, over the last 20 years, we had two 20% drops. When things were really frothy with the dot-com bust, we had a 52% drop back in 08 and 09. And then if we zoom in closer here, where my personal view of things, going into 2020 was that we were due for recession. The yield curve had inverted back in 2019, and things were slowing down. The repo markets were all over the place, and you can see that we dropped 35%. So 35%, 52%, and 20% drops in the last 20 years. So where will we go? Here in the near future, can't say. I have no idea. But, now is the time to position things. If you need to reposition your portfolios so that you're not going to get kicked in the balls too hard, now's the time to do it. You don't wait until the hurricane gets here to board up your house. You go to Lowe's or Home Depot a week or two prior, or you already have the stuff ready for that event, in case of emergency. I grew up in Houston on the Gulf Coast. I'm very familiar with hurricanes. And then I lived in Jacksonville, Florida for 10 years where we had a couple near misses, but no direct hits in the years I lived there. But again, you were always prepared. It was always in the back of your mind. Hey, especially in Houston, always seems like hurricanes just they come into the Gulf and just from like Pensacola to Brownsville, you're just right in the heart of Hurricane Alley. So, anyways, my advice: be prepared. If you need some help with that, hey, someone like me that's what I'm here for. Feel free to reach out. If anyone needs anything else from me, don't hesitate to go to my website, dsafinancialgroup.com. All my contact information is there. So if you want to send me a note, send me something you'd like me to review or comment on, feel free to do so. Or if you want to book a meeting, feel free to book an appointment with me, and we can talk about the goals that you have, what you want to accomplish, and where you want to go. So, all right. Well, that's everything I had for today. I hope this information was valuable. If it wasn't, I'll do better tomorrow. So, all right. Hope everyone has a fantastic evening, and I will be back tomorrow. Have a good evening. Bye-bye.